York. Hey, Will.
Hey, Morgan. Yes, indeed. I'm delighted to be with the host of the conference, no less, as well, the president and COO of Goldman Sachs, John Waldron. John, thanks so much for having me.
Thank you for being here. Thank you for covering our conference.
No, it's great to be here, as it always is. End of the year, people sort of setting out their stall expectations for the year ahead. What have been the key themes for you so far from all the banks we've heard from?
Well, a lot of discussion about the economy and the consumer in particular. The strength, the underlying strength in the consumer, I think, is showing through, and you're hearing people talk about it a lot today. Regulation and the election and the prospects of whether there might be some shift in the regulatory environment, which obviously affects banks meaningfully. And then I would say an incremental conversation this year may be more pronounced than before around technology, the impact of technology, the amount of technology spend. Where are we in the disruptive phase of financial services more broadly? That's become more of a prominent theme that we think about at Goldman Sachs quite a lot, and it's certainly been a focus today with our clients.
We'll definitely dive into what you guys are doing on that front coming up. In terms of the macro sentiment, is the consumer strong enough to be offsetting perhaps less lackluster, a little bit more lackluster kind of corporate momentum?
I mean, we're pretty constructive on the overall economy, certainly in the United States in particular. The economy feels, if anything, like it might be accelerating again from what had been a little bit more of a patchy 2019, certainly in the first half. I do think the Fed's easing bias has made a big impact. You know, our financial conditions index is operating at a very relatively historic low level. So we're seeing that implication of easier policy coming through into the economy, and it's become much more of a stimulant for particularly consumers, but corporations as well. Manufacturing weaker, no question. But again, 70% of the U.S. economy is really driven by the consumer. So as goes the consumer, typically that's where the economy runs.
And on the corporate side, we did see all of a sudden some M&A announced last month. Did you guys take part in that? And are you optimistic that that can continue next year? Or was it kind of a last flurry, as it were, for 2019?
Well, I think, again, consistent with an easing bias in monetary policy, a renewed risk appetite in the markets, I think improved sentiment in CEO offices and in boardrooms, we're seeing more M&A activity, and it's kind of what you would have expected at this point. Our market shares are very good in M&A. We did participate in the vast majority of those transactions. We have more transactions that are on the docket. We feel good about where we are with our backlogs, and I think the activity levels have definitely elevated from where they would have been 30, 60 days ago.
And what about IPO outlook? Has that been genuinely damaged by the whole WeWork debacle?
No, I don't think so. I think the IPO market is still fundamentally healthy. You have individual transactions that come and go and have their own characteristics, but broadly speaking, there's demand for IPOs, and there's a lot of supply coming. A number of good companies. We're doing an IPO today in Brazil that's going very well. So, I think the market is doing quite well.
To focus more on Goldman Sachs, you guys have a very important strategy update coming in January. How are you guys all preparing for that?
Well, we spent the better part of the year getting ourselves organized, not just for the Investor Day, but for orienting the firm really for growth. And so when we come out in January, we'll talk a bunch about that. We'll talk about our strategy. We'll talk about the direction of travel in terms of our investing and what we're doing to build new businesses adjacent to our core franchises, and some new businesses like consumer, which are more new builds for us from the ground up. And we will have targets, around profitability and efficiency. And so we'll talk more about that in January, but we're excited about it. So
the FT article recently that suggested you're not going to be setting strict financial targets, I'd say the tone even suggested you were going to try and duck out in that sense. Was that a false sentiment?
I've learned in this job you can't believe everything you read or hear on TV sometimes.
Unless you say,
of course not on your show.
So we're grateful.
But I wouldn't believe everything you read in any of the publications. What I said is what you should expect to hear.
And did David, Stephen, yourself, do you see this strategy update and of course the investor reaction to it? Do you see it as a kind of mark on your guys' first year in tenure? Is there a sense of nerves at all coming into this update?
No, I don't think so. I think we're excited about it because it's an opportunity for us to describe in more detailed terms what we're trying to achieve with the firm over a long period of time. And I think the over a long period of time part is going to be important. We really want to lay out a roadmap for where we're trying to go over a number of years. And that's something that I think will be a little bit different from what we've done in the years past, and we're looking forward to that.
One of the themes that people, I guess, have heard a little bit about, but maybe not a full story about, is how much you want to shift towards the kind of private equity space. You've reorganized internally to have a specific department to that. In 5 years' time, is that going to be 2% of earnings? Is it going to be 25% of earnings?
Well, I don't want to make a prediction on how big it'll be, but I would say a couple things. We have a 30-year track record as an investor in private asset classes, private equity, credit, real estate, et cetera. So we have a real business that's scaled. We haven't necessarily described it as such in more unified terms, which we will do more in more detail in January. We think it's a secular growth opportunity in the world. You can see how hard it is to create alpha in the public markets. More money is flowing into private markets. As I said, we have a long track record, so we're very bullish on the opportunity, and we have a scale business. So we're going to be an active player in that arena, and we're going to describe it in more detail as we get into it in January.
Are you nervous about the timing of that in any way, whether that's because issues like WeWork showing that private market valuations in some areas at least might have peaked already? And on top of that, we've seen price wars in active management of public equities, in the brokers as well. Could private equity not be the next area to see a price war?
Again, we're not making a market call on being in the alternative business. This is a long-term bet that we're making, and that this is a secular growth opportunity, and we have a reason for being. We have unique attributes. We've got a very big sourcing engine in our investment banking business, which lots of our clients want to access. And we can have our own private equity and credit and real estate opportunities to access that as well in partnership with our clients. We also have a unique, I think, ability to talk to our institutional clients about risk management, allocation of capital, and we can offer them products that can help them do that in a more intelligent manner. So we think we bring a lot of unique things to the table, and we're very excited about the opportunity to build an even bigger alternatives business over time.
You mentioned the spend on tech as a theme that's come out at the conference, and we've seen that play out recently in a subsector in the brokers. Robinhood enters, leads to a price war, and then leads to some consolidation amongst the big players, Schwab and TD Ameritrade announcing a deal. Do you think of Goldman Sachs as a tech challenger, or as the incumbent being challenged?
Well, it's a good question. I think we probably sit in both seats. You know, we have a lot of legacy businesses where you could see some challenge to legacy ways of doing business, and we have some businesses that would be more disruptive. I would say what we're doing in the consumer arena would probably tend to be more disruptive. We're trying to build a digital storefront, a digital bank of the future. That's more disruptive versus what would be the legacy infrastructure in consumer. In the markets businesses, we're trying to be ahead of the curve, almost disrupting ourselves in many respects, to have straight-through processing and other platform capability when you move from more voice legacy transmission of risk intermediation into more platform and technology. So in that case, we're probably trying to make sure we're disrupting ourselves so we're not getting disrupted by others. And on the consumer side, we're more of a disruptor. I'd say in transaction banking, it's a combination of the two. We're building a new platform. It will be disruptive. We think it'll be a great product. We think it'll be an improvement on what's in the marketplace. But we're also taking advantage of legacy existing corporate relationships that are quite strong and important in a trusted advisory context where we can offer something else that's a part of our toolkit that will be valuable to our clients.
That broker price war obviously led to some suppressed prices, and the Schwab TD deal came about partly because of that. Some people criticize your predecessor, the leadership that came before you and David, for not making more moves when prices were depressed after the crisis, not being acquisitive then. Have you sensed any opportunities at the moment? People have tried to link Goldman Sachs to E-Trade, for example.
Well, we're not going to comment on individual names, but we did make an acquisition in the wealth space recently, a company called United Capital, which is an RIA, a national platform in the United States that's got a very good kind of high net worth wealth platform that we're going to build upon. So when we see opportunities that allow us to accelerate our existing organic plans, we're going to look hard and want to access those opportunities. But the bar for doing something more transformational or of larger scale is very, very high, and will continue to be so.
Let's move on to the Apple Card in partnership with you guys. David said on the recent earnings call, which I discussed with him when I interviewed him recently, that it was the most successful credit card launch ever. The numbers may say that. I wonder whether you guys retract at least part of that sentiment, given the scandal that came up about potential gender bias in terms of the credit issuing decisions. Was that a blow?
Well, the way I think about this is we're starting a new business. It's in partnership with Apple. It's the first real credit card launch in a long time, and it's going well. We've got a lot of new customers. The usage rates are very high. We're feeling very good about how the processing is working. The tech platform is working very, very well. Apple's a great partner, and so there's a lot to be very, very pleased about, and we'll talk more about the details of that, obviously, in the coming weeks and months ahead. Vis-a-vis the gender question that was that you asked around the credit approval process, we're very comfortable. There's no gender bias in our approval process. It's quite easy to go look at that. You can look at it on the phone in terms of what the factors are that drive the approval process. There's no gender. There's no marital status. So we don't believe there's any gender issue at all. We do think we maybe have an ability to go talk to the world about the fact that it may be harder for for women, as an example, to get credit. And so we may be, shining a spotlight a little bit on that, which I think is a good thing to be talking about in the world. But we don't believe we have any bias in our processes.
In terms of the card itself, Apple announced today that you can buy an iPhone spread over 24-month installments with no interest if you use the Goldman Sachs Apple card. So is that you have to forego the interest, or Apple compensates you for that? Talk us through that.
Well, I don't want to talk about our economic relationship with Apple, but it's another example of where we're trying to be innovative and help the consumer. The whole basis under which we're doing this Apple card with Apple as our partner is simplicity, ease of use, transparency, and trying to be sort of democratize, if you will, financial wellness out in the world. And Apple is a great partner for that. First of all, they've got a lot of customers on the phone, and so it's very easy to access those customers. Mm-hmm. And we're trying to mimic a lot of what Apple does well anyway, which is to be very simple and easy to use and allow people to have tools at their disposal to make their life better.
I want to ask you about 1MDB. On the earnings call, Stephen Scher said that during the quarter, we elected to suspend our open market repurchases as we'd begun discussions with certain U.S. governmental authorities with respect to the resolution of the 1MDB matter. Since then, last week and just the week before, both the U.S. and Malaysian sides have seen stories suggest that you're close to a settlement, and they've not come out to outright deny those stories. So I feel like there's a sense in the market that you guys are very close to a settlement. Is this something that will be done in Q1?
Very hard to predict the timing of any of this. All I can say is that we are working to try to solve this as expeditiously as possible. We don't control all the outcome, obviously. Mm-hmm. We're one party. We have a number of people to talk to. And that's really all I can say. But we're working as hard as we can to try to get it resolved sensibly.
Do you feel like it's suppressing the share price if people say it's been trading at or below price to book value? Do you think settlement of this is something that would see it go back above that threshold?
I wouldn't say we're really particularly focused on the impact it has or doesn't have on our share price at the moment. We'd like to get it settled. We'd like to get it resolved. We'd like to get focused on all the other good things that we're working on, and that's where weid like to be spending our time and energy.
The final question, John, which I think lots of people genuinely really interested in it. We all know that David enjoys some downtime DJing. What's your number one hobby outside of work?
My number one hobby is I have 6 children, and so they are my number one hobby. I coach my son's hockey team, and I spend a lot of time with my daughter and her travel soccer team, and that occupies most of my time. So I'm not spending a lot of time doing much else other than working at Goldman Sachs and being with my family.
Well, that hobby is much more important than the job, but it's great to discuss the job with you. Thanks for having us at the conference.
Appreciate the time. Thank you.